All right, trying to end this month on a high note. We've had some strong earnings reports. One of the things helping to lift stocks at the end of the month. We're up 366 on the Dow Jones Industrial Average today, on top of the 400 points at the end of the day yesterday. Let's bring Mike Lee and Ryan Payne in. They're both here in studio with me to talk about this wacky market. And what do you think, Ryan? I mean, it's the idea that we end on a high note, a sign that we're closer to the end than the beginning of some sort of phase we're going through. How do you look at it?
Well, I think corrections are always defined by a lot of volatility, so that's probably a good sign. And I I'm a retail. I deal with a retail investor. They panicked a little bit last week. I don't know if they did for you, Mike. To me, that's always a good sign because they're always a negative indicator column.
Well, it was interesting because we had a guest on last hour who basically said the same thing. We were talking at the time about where to find yield and this environment of rising interest rates. She was saying, yeah, some of her clients came into her, and she kind of had to remind them that you could actually own bonds also, not stocks. That there are other places, but people have to adjust and kind of get used to the environment that we're in. What are you noticing?
So interest rates are going higher. I believe the volatility that we got earlier this year and the volatility we have now is from interest rates starting to come off their lows. I think there has been a healthy dose of skepticism every time Powell said he was going to raise rates and that the Fed was going to keep going and that the 10-year and the 30-year were going to rise. Every time that skepticism goes away and becomes a reality,
right.
That's when I would say more institutional investors, more fast money investors hit the panic button, hit sell, and we just see a tremendous amount of volatility.
What's the bullish case? I know you're bullish. I've seen you be appearing on other shows. You say long term you're still a bullish guy. Now I get somebody like Dennis Gartman who comes on the other day, says we're already in a bear market. I can think of interviewing Gary Kaltbaum a number of times. He says, hey, listen, I'd love to be bullish, but all the signs I'm seeing here are bearish. What's the bullish case right now?
So we are nowhere near the end of the business cycle. So when we look at the business cycle, I think Ray Dalio refers to it as a debt cycle.
Right.
There is no signs of excess anywhere except for maybe a few tech names, right? And so maybe Amazon got a little bit too high, Netflix got a little bit too high, but I can tell you what, I'm not going to stop streaming movies. I'm not going to stop buying stuff online. So where is the debt bubble? Corporate balance sheets, we've seen a little bit of leverage increase over the last year or so, but still close to the cleanest balance sheets we've ever had in history. You look at personal balance sheets, if you look at debt service payments as a percentage of take-home income,
right.
Okay, for the household, it's at the lowest level in 30 years.
Yeah.
You look at the savings rate, almost up close to 7%.
Okay.
So we're nowhere near the end of the business cycle. And so we may have these fits and spurts where the market looks really ugly and you want to hide under your desk, but...
Is that all it is then?
Yeah.
You think we're in a fit that we're in the middle of here?
Well, I think what's deceiving, and this is a good point, is this is one of the longest economic expansions of all time.
Oh,
so,
yeah.
you would think rationally, well, we got to be near the end of it. But the caveat is it's one of the slowest economic expansions of all time. So to Mike's point, there's just not a lot of overheating. And, we've been through a couple of business cycles and market cycles. Like, when the overheating's there, and we're just not there yet.
Give us a sign. You don't see inflation where it would be. Is that what don't you see that you normally would see?
We see modest inflation, number one, right?
Right.
Yeah, we're not seeing inflation skyrocketing. Rates have been going up for now 2.5 years. We forget that. The bottom was 2.5 years ago.
True.
But the other thing is just anecdotally, when I talk to business owners, it's like, man, they need to hire right now. They can't find enough people to get to work. I mean, these are really, really good signs. This is a hot economy.
That's fair.
Yeah.
What about some of the tensions that are out there? We talk about, for example, a trade war or trade skirmish or whatever we're calling it these days that's going on. A lot of companies, you like skirmish? A lot of companies have been mentioning it, though, to be fair, in their conference calls. You talk to Caterpillar, you talk to 3M. I even read into the Texas Instruments report as saying that, yeah, at the end product game here, we're seeing some tensions that are related to trade.
I think if this was going to be this drawn-out trade war that was going to somehow drag us into a recession, we'd be seeing a lot more than comments. I think what you're getting in earnings right now is that from 17 to 18, we had such high top line and bottom line growth that the comparables from 18 to 19 are really hard. So you're getting a lot of what we call kitchen sink throwing. So we're trying to get all the bad news out now, set expectations low so we can outperform in the next year. But you're still conservatively looking at double-digit bottom line growth next year. And then, mid to high single-digit revenue growth next year on top of a strengthening economy.
As a final kind of point in all this, is this now a time to be shifting to different types of investments in stocks? Or do you say to yourself, those growth names that drove us up, that now are, bouncing today, that's, you had a chance, let's get in after they pull back 20, 30%?
I mean, I like Warren Buffett, be greedy when others are fearful. And I mean, you got to love like the emerging markets are getting hammered right now. International markets, value stocks are a great value. Like get your money diversified. I would stay away from just concentrating in those growth names. This is your shot to do it.
Okay. What's your view? Are you making any changes in terms of how you approach this?
No. Look, this has been a rough month. We've taken a long, hard look at everything that we're doing. But then, again, you take a step back and you look at the underlying fundamentals. Well, it's nice when the market wants to overpay for what you own and things aren't on sale. But, again, stocks are the only thing that people don't want to buy when they are on sale. So we're holding pat. I think we're going much, much higher.
And that's over a long period of time, though. That's a
long...
this volatility, this up and down, this stuff's here for a while. Does everybody agree on that?
It's the normal volatility of the market. The market has a 10% correction on average every year. This is normal.
But some of it's happening very quickly, like these last few days. Is that kind of that's normal now?
It always happens, Colin. We forget about it.
No, it's true. And the other thing, by the way, to be fair, I should have caught myself on this. Sometimes we do get caught up in big moves of points. You know, in the Dow, 600, 700, 800 points, and a Dow at 25,000. I mean, even today, what's the percentage move in the Dow? Not much. So when we get 370 to the upside, it sounds like a great day, but it's not like we're up 5%. We're up 1.7%, I think, is what it says right there. So,
look, I'd also say when you're looking at some of these big names that everyone talks about and everybody owns, is that the ownership of those are a lot of open-ended mutual funds that are long only. And those management companies are under such pressure for performance because if they underperform by a small amount, okay, the redemptions just come in from left and right. So they all need to own the same names at the same time. And when something goes awry, they all have to sell at the same time. So these moves get exacerbated in both directions. And then also you look at like quantitative hedge funds, factor-based, that are levered up 3 and 4 to 1, that push these names around. They buy on strength, they sell on weakness. So look, if you're an individual investor, you put your money to work, you can sleep well at night.
All right, we're going to run now, but thanks, Mike. We appreciate it. Ryan, good stuff. Thanks for coming out, guys.